Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is Friday, February the 23rd, and we have Brent crude oil trading little changed, down 0.5%, but still very much stuck to that $83 a barrel handle, up a few pennies, down a few pennies, stable as you go this week. Let's kick off with Jamie Ingram, senior editor at the Middle East Economic Survey. Jamie, your read on the oil price, I mean, stabilizing around 83 after a few weeks of some volatility up and down 5%, but now holding at 83. Is this a sort of a base camp before ascendancy to 90, or what's your outlook?
That's the question of the moment, isn't it, Sean? Yeah, forecasting prices is a terribly difficult job, I hear. Yeah, look, one of the big things that everybody's waiting for, of course, is what's going to happen with these voluntary cuts from key OPEC plus producers like Saudi Arabia. We're expecting to see a decision on that in early March as to whether they're going to extend the cuts in full beyond Q1 or whether they'll start to ease them off of the table from now. But it's interesting, as you say, kind of look steady as she goes on the surface. But we've seen in recent weeks a lot more backwardation start to creep into the futures curves, which is certainly suggesting that we're seeing a bit of a tightening of the market now. Whether that's base camp towards 90, I wouldn't want to come on as strong as that. I suspect that we're going to get pulled back down beneath the 80 level at some point again and then bounce back up beyond that. We've been very much range bound in that kind of 75 to 82, 83 kind of position for the start of 2024. And frankly, I'm not seeing a breakout on the prospects at the moment.
Let's go to Dr. Rad Al-Qadiri, non-resident fellow at the Center for Strategic and International Studies in Washington, D.C. Dr. Rad, your thoughts on where the geopolitical risk premium in the oil markets is at the moment, absorbing numerous kind of global and regional events. Your thoughts on the impact it's having on the oil markets halfway through the first quarter?
I think the oil markets are in the same place in many ways that they were sort of at the end of last year, in an almost wait and see position. I think obviously you've seen an uptick over the past couple of weeks, but this is a market that still wants to be shown that there are going to be disruptions, as opposed to anticipating or pricing them in advance. I mean, the Red Sea disruptions to freight have had some impact, but ultimately I think the market has become a little sanguine in terms of the conflict in Gaza being contained. I think the sort of sense is maybe that efforts to try and find some sort of settlement are happening, and in that sense the market may be being lulled into a false sense of security, and plus the fact that you still have the sort of concerns on the demand side that sort of are there, and a sense of adequate supply. I mean, the market hasn't changed really since October in terms of that mindset, and I think that's where we're going moving forwards. And as far as geopolitics is concerned, it is a show me rather than I'm going to worry about it.
Show me, don't tell me is the sort of the narrative there. Let's welcome Shuaib Boutamin, energy advisor and CEO of Ranadrill Consulting, based out of Algeria. Your thoughts on the sort of market supply-demand dynamics, Shuaib? Of course, Algeria, member of OPEC, meeting its quotas, having difficulties. Your thoughts on that sort of supply challenge to the OPEC countries?
Yeah, good morning, everybody.
Good morning.
I think I strongly believe that the main problem at the moment is fundamentals in the offer and demand. So we have, as you said, even we have some troubles in the Red Sea, we have problems over there, and the risk of supply disruption. Even on the other side, we have some drones strikes and attacks on the Russian refineries. But even that, really, we see the oil prices will just in the last 3 or 4 months between 75 to 80, $83. So let's say an average of $77. I think even these troubles, these problems, and a rising tension in many regions in the world, but oil prices didn't spike a lot, didn't reach 90 or $100 in the last few weeks or few months. So the problem is, as I told you, fundamentals, offer and demand. But another side, the OPEC members, OPEC plus members, took some decisions. So they took some decision. They have at the moment they have a cut of 3.66 billion barrels per day to the end of December 24. But meanwhile, we have a voluntary cut of 2.2 million barrels per day. But even those efforts have been regulation, let's say, decisions took by really OPEC plus, but even that price is still a little bit not really high. I think that the main issue at the moment we have, as I told you, fundamentals, but we have the big problem is the interest rate still a little bit high in the US. We have 5.5 in the US and 4.5 in the European Union. So the central banks still striving and struggling to lower the inflation, and this is the main concern, the main problem, I believe, at the moment. So we cannot really say that oil prices will increase in the upcoming few weeks or month, because we have inflation still high, and there is I have one point very important, it's really crucial. If we talk about the U.S. elections by the end of the year, I think there is some issues at the moment, because the United States at the moment, if you remember, the SPR 2 years ago was like 557 million barrels. At the moment, they are 359. So the actual administration is trying to fill up the stockpile of strategic SPR, and before the end of the year, they try to fill up like more and more million barrels, at least if there will be some another administration to come up, so they will deliver them SPR with a good fill up, I believe.
We'll have to see if that happens, of course, given that U.S. elections are coming. But Jamie, maybe give us some of your thoughts as to, not so much about, where the oil price is going, but more what's keeping it in this relatively tight range. In some ways, I'm kind of schizophrenic around interest rates higher for longer. In some ways, feels that's kind of bullish because it indicates the economy in the US, at least the Fed, the world's largest oil consuming country, is doing reasonably well. So they're not having to raise rates. I mean, what do you think caps the ceiling on this oil price, and what's the floor? And within those, is there anything that could crack first? Your thoughts first on what's keeping this in its tight range.
Yeah, sure. I mean, one of the big cap things, of course, is a lot of uncertainty on the demand side of the equation. People are still pointing towards China. There was a big year-on-year increase recently in demand over the lunar holiday, but then there's speculation how much of that is that the economy is actually driving demand forward at the moment, and how much of that is essentially that, even this time last year, there was still a bit of a latent COVID drag in China. So a lot of that is just the COVID effect being wound out of the system. Then on the supply side, there's a lot of debate over, yes, despite economic headwinds, generally the picture on demand is very, very strong. Even the IEA, which is the most bearish, is still looking at 1.4 million barrels a day growth this year. That's very historically pretty strong. OPEC extraordinarily bullish, more than 2 million barrels a day. The IEA kind of sitting somewhere in the middle on about 1.6. So even the most bearish figures point to strong demand growth, but the supply side is expected to broadly cancel that out. Uncertainty over whether the US can repeat the trick this year in terms of supply gains, massive supply gains there. Yes, the trend is generally up, but a bit of pessimism creeping into as to how fast the US will continue increasing production this year, especially as we're seeing drilling rates kind of dropping somewhat in the US. Guyana, of course, also expected to bring on a lot of production. So you've got a lot of uncertainty on both sides. How much is interest rates going to be dropping down the demand equation from very high to high, and how much non-OPEC supply is going to be coming in? And of course, the big uncertainty, as always, coming up is OPEC plus. They're going to be making that decision soon, as I referenced earlier. One of the big issues that they're going to be looking at is Q1 inventories. My feeling is that it's probably going to be a little bit early by the time they make a decision as to whether they will have succeeded in their main goal, which is to bring down Q1 inventories to make sure that the year as a whole balances. When I say bring down sufficiently to meet their goals. So I wouldn't be surprised if we start to see a bit of If in the next couple of weeks we see OPEC plus countries extend their voluntary cuts by a little bit, maybe not through all of Q2, but at least into April, and that's one of the things that's really going to be moving the market in the relatively near future.
Rad, your thoughts on that same idea? I mean, does it feel, or does it look to you that the what's keeping it in this range, the cap and the floor, is more solid on the floor or on the cap? I mean, which of the two are likely to break first that could give us an upward move or a downward? Your thoughts on that?
Look, I think this is a market that has been sort of focused on the floor for some time. And as Jamie said, this is a market that's been concerned about demand growth, even with the high numbers, certainly coming down from sort of what we saw last year. And a market that believes that you're going to get sufficient non-OPEC supply and bits of quota sort of busting on the OPEC plus side that's going to sort of balance things out. And I think that's what sort of kept the floor in place and what's kept a broadly benignly sort of bearish view in the market. So if you're sort of looking at breakout, I think sort of this is a market, as I said, that wants to be convinced that there's a supply issue. And therefore, that's where you might get the change. I think one thing that sort of is out there that could significantly hit some of these balances and isn't sort of really being sort of factored in by OPEC or anyone else is Iraqi production. The Federal Supreme Court took a decision a couple of days ago, which essentially said that the Kurds had to pay indirectly any oil revenue from their producing regions into the budget in exchange, essentially, for the government guaranteeing salaries and guaranteeing that salaries would be paid directly from Baghdad. That may be an incentive for Baghdad to look more seriously at the pipeline with Turkey and how to open that up. And then you're sort of talking about an additional 450, 500,000 barrels a day of production and of exports that might come back on. But on the whole, you'd have to say that if we're going to see a surprise, something that this market hasn't priced in yet, it's going to be on the upside, and it will be an escalation of a war in the Middle East. And right now, the market has convinced itself, and events seem to reinforced or given a full sense of security that that's under control.
And is that a false reading of the tea leaves here? I mean, this sort of threat, the Israeli threat to go into Rafah, come the next week or the early March, which is sort of high dawn kind of threat of scale, the final push of clearing out Gaza into Egypt. I mean, where do you see that going?
I mean, look, what it's going to be and what the market is a sentiment in terms of oil markets. What's essentially said is sort of rather cynically, look, if it doesn't impact production, it doesn't impact markets. And so it's probably going to be less Rafah, although that will sort of create more outrage, and rightfully so. If that happens, it's going to be signs that there's an escalation that drags this war east. I mean, what the market is concerned about fundamentally, or what will get its attention, is if this war starts to creep more obviously towards Iran, and there are potential threats in the Persian Gulf. I mean, given the sort of issues in terms of the Gulf, given the fact that it's a different waterway, not all waterways are created equal, and it's certainly the case in terms of the Gulf and getting oil, the bottlenecks that are there and the lack of alternative routes that are there compared to the Red Sea. So what we would have to start sort of seeing is an escalation of tension that leads to some sort of direct or indirect scrap on the Iranian side. And, again, after some real worries about that, I think the sort of market has convinced itself that isn't going to happen. Again, this war may be sort of we may be in a lull in this war as opposed to sort of hitting the end of it. And that's the bit that would worry me.
Don't misread the silent, not that it's silent, obviously, but ultimately don't misread what the pause or not pause. Shoaib, I wanted to get your thoughts on all things gas, LNG. Of course, Algeria, big gas producer, big gas supplier to Europe. Has Algeria been able to sort of be a winner in the turn away from Russia, and the outlook for Algerian gas to grow, and to obviously Europe keen for new suppliers, and a lot of it being met by the US? Where's Algeria's future in expanded supply opportunities into Europe?
Yeah, great question. Yeah, as you said, Algeria is the largest producer of natural gas in Africa and the biggest exporter in Africa. And it became last year, became the biggest LNG exporter in the African continent, and it overtook Nigeria. So natural gas, I believe, has a crucial role if we talk about the energy transition. And we see when the war just started in Ukraine and Russia, European leaders scrambled and were in rush to Algeria and to many countries to diversify their natural gas supplies. And Algeria responded quickly and tried to increase its production. And I think, yes, it's increased it a little bit in the few last 2 years. But I believe that there is a good investment. Algerian government now took Sonatrach national company is investing more than $14 billion in the upcoming 4 years, prior to increase and to meet the European needs in kind of natural gas. But allow me to tell you something very important. There is a big shift in kind of natural gas supplies. So before the war in Ukraine, European Union was getting like more than 40% of natural gas supplies from Russia, but most of them were delivered through the pipes. At the moment, there is a shift. European Union is getting too much LNG through the vessels, and the United States became, at the moment, is the biggest producer and exporter of natural gas in the world, and LNG especially. So 63-64% of LNG exported by the United States is driven to the European Union. So this European Union is a very good market. It's a large market.
And is Algeria in a good position to take advantage of this new, the turn away from Russia leaves a huge gap to fill. We're seeing Qatar fill it. We're seeing obviously the US fill it. Can Algeria play a bigger role? Do you have the infrastructure, the capital investment to take advantage of this opportunity?
Yeah, for sure. But Algeria cannot really fill up the gap left by Russia. We have to be
not
clear.
all of it, but
it's
some of it.
Exactly, some of it. Algeria is increasing its production, and Algeria will host in 1 week the GECF, gas exporting countries forum. So they will discuss how really can talk about how maybe about situation of natural gas prices. Just me remind everybody that in summer 2022, natural gas prices in TTF in Europe rose to 350 euros per megawatt. Now they are 24, 25, so they lost like 14, 15 fold. So this is a very, very big gap in kind of prices. But that really caused by some 3 reasons, I believe. The first one is the European Union have a very good stockpile at the moment. So they have a capacity of a stockpile of 103 billion cubic meters, but at the moment they are like 75% of fill up. The United States, they have also a very good stockpile of natural gas. We have mild temperatures in the European Union, so that allowed the European Union to save more energy. That's why we see that our prices a little bit low. But anyway, Algeria keeps investing in natural gas and even oil and trying to meet the European Union needs, but it will be not enough. More investment, need to entice more investment to increase the Algerian share in the European Union.
Yes, there's certainly an opportunity with the mild weather. It's kind of a catch-22. Putting billions of dollars into a commodity where prices are at 30-year lows is another challenge. Let's go to the question of the survey question of the podcast, which is looking a little bit at the issue of geopolitical risk premium in the oil price remains in low single digits. That we have some analysts in our group who see the oil price is well, or the premium, geopolitical risk premium is in double digits, as much as $20 a barrel. We're putting forward the thesis here that actually the geopolitical risk premium, the oil price, remains in the low single digits. Do you agree with that statement or disagree with it? Welcome your thoughts on that. Jamie, I wanted to get your views on the some stories related to the expansion of the national energy companies in the region. We have ADNOC drilling plans post sort of COP28 now. We're seeing ADNOC, the biggest national energy company in the UAE, but others, Qatar Energy, Aramco, all looking at moving into international opportunities. And your thoughts on what that looks like? The latest in that story is the ADNOC drilling aims to expand its rigs and services around the region. What does that look like? Who does that sort of rub shoulders with from a market competition point of view?
Hi, Sean. Yeah, the NOC expansion is very interesting. I think I'll start with the upstream side of things first of all. Qatar Energy, I'd say, has probably been the forerunner when it comes to international expansion. They're going guns in all areas essentially. I think that we're gonna, it's been pushed back into next year, but Qatar, their investment in the US LNG is going to come online relatively soon, Golden Pass export facility. So that's very interesting. Clearly, there's a lot of focus on their domestic LNG facilities ramping up from 77 million tons a year to 126 by 2028 or so. But getting, starting to operate in the US LNG sector, which has overtaken them, and Australia to be the largest in the world. That's huge for them. It gives them a lot more volumes to market from the other side of the Atlantic basin. But ADNOC is the new player on the scene when it comes to international. ADNOC drilling, they've got small plans. I think they've got one rig in Jordan at the moment. They're going to struggle to make much headway in other GCC states. I don't think they're going to pick up any significant contracts, if any at all, in Saudi Arabia, quite frankly, just because of a little bit of rivalry between big neighbors. But on the upstream side of things, we've recently seen them pick up assets in Egypt through a new joint venture which is being formed with BP. They see kind of the East Med as a whole as quite a strategic gas basin for them. But there's also obviously a lot of political sides to this. They're also looking to move into Libya potentially. That's very much a G2G kind of a play. Big strong ties between the governments there, also strong ties between the UAE and Egypt. This is very much a way for them to show the government in Cairo that, look, we have your back. We know how important the gas production is for your economy, and we're going to invest in your upstream to prevent some of these natural declines that have always been a problem for operators in Egypt. And then finally, the big one that you mentioned of Aramco, of course, they're starting to move overseas. LNG is the big play they're looking to get into with an investment in a firm called Mid-Ocean Energy, which is finalizing deals to farm into certain Australian projects. So that's interesting that we're going to see Qatar starting to produce LNG in the US. We're going to see Aramco start to produce LNG in Australia, which of course is the number 2 in the world. So yeah, a lot of interesting developments on that. Definitely keep an eye on the NOCs. They're the ones that are actually have the money and the will to invest, when a lot of the IOCs have started to retrench on their positions somewhat in recent years.
Rad, just to pick up on that, the IOCs, the international oil companies, particularly the U.S. majors, the outlook in this year of the election in the U.S., if you look at one of the weaker kind of floorboards in this oil price range and this tight sort of $78 to $83 kind of bandwidth, one of the weak boards on the floor is non-OPEC plus supply. We saw the US and other, Guyana, Canada, Norway even, but in the Americas, non-OPEC plus oil producers who are not confined or limited by any OPEC plus quotas, adding supply. And at the forecast of growth this year at 1.2 million barrels a day, according to the IEA. Of course, OPEC has it at 2.2. But nonetheless, where do you see the U.S. election intersecting with the potential of more supply coming into the market in the U.S.? Of course, the U.S. Administration always loves a low gasoline price during an election year. But where do you see the opportunity for growth in supply in the Americas in this election year?
I think it's going to be, I mean, you're right about the gasoline prices. Obviously, that becomes a domestic economy issue. And I believe a phrase was coined a long time ago. It's the economy, stupid, that sort of, in terms of going into elections. I don't think that's necessarily going to play into some of the core decisions that are going to drive US production this year. What the essential unknown is, and Jamie pointed to earlier, the essential unknown is whether the sort of gangbusters growth that we saw last year, that I think some forecast for this year as well, including the IEA initially, is going to be met, or whether some of the dynamics of the internal market in the US has actually sort of meant that some of that production growth was brought forward into the third and fourth quarter of last year, as opposed to the early part of this year. It's very clear that there was maneuvering for some of the private companies that were sort of positioning themselves for maximum valuation as they were looking for suitors, and you've seen some of those big acquisitions already take place, and that shifted the sort of US sector a little bit away from sort of some of the discipline that you'd seen and some of the spending discipline you'd seen. So as that plays into this year, you've got certainly on the sort of unconventional side and places like the Permian, what you've got is a different structure in terms of the domestic producer base and the domestic producer sort of landscape, with these bigger companies, Exxon, Chevron, having sort of made big acquisitions, but are going to be all about discipline and capital discipline, and that sense that therefore maybe some of the growth was anticipated initially on the back of last year's pattern being brought into this year as well. I think you're going to see some easing. Now, in political terms, I mean, I think what you're going to see is an administration, a Biden administration, that won't get in the way of the sector. It's not going to do anything to sort of retard the sector. It certainly doesn't want the oil and gas sector to become an issue in the election that it can be panned on. And
what about drawing on the
Strategic
Petroleum Reserve in a relatively liberal fashion, i.e. that it's not there for national security stress moments, but to sort of soften the price?
I think, yeah, but what this has shown is that you can only do that so many times unless you replenish it. And there's been a debate about the levels of SPR levels in the US for some time, and efforts that sort of go back into the mid 2010s that sort of were about actually sort of reducing that level, that it was too high and it could be monetized and used for other things. So I think, that isn't necessarily, I mean, that set a precedent at a time of crisis, and one that I think the US could use again. But I don't think you're going to see a massive buildup of the SPR this year in preparation for anything. And as long as prices remain where they are, let's be sort of honest, the US is quite sanguine about it. It keeps domestic production growing, maybe not at the same rate, but it doesn't mean that sort of you have massive inflation or sort of very large sort of high prices at the pump. So, things are good.
Yeah, it's a sweet spot.
If it ain't broke, don't fix it.
Yeah, it's the kind of Goldilocks sweet point. Last word for you, Shuaib. I wanted to take advantage of getting you. It's not often we have a view from Algeria, and of course, a long-term member of OPEC. OPEC is facing some decisions this year about, obviously, they're going to maintain their cuts or not. It's just kind of short term. But in the longer term, beyond this year, there is the issue of production quotas, oil production quotas, and there's been some stress around that subject within certain countries. What is Algeria's view on continuing with the quota system within OPEC Plus? Is it working? Is it broken? What's the Algeria view on OPEC Plus quotas?
Yeah, I think Algeria was for all time has been aligned with all the OPEC or OPEC Plus decision. But my point of view is keeping voluntary cuts, all the cuts for a long time is not good for the OPEC Plus members. It's not really good, because if we keep cutting oil, supplies to the market, another production will come up from spur and will come up from another countries like Brazil, United States, and Guyana. So this is very in short terms. It's okay. It's fine. You can plan and supplies you can cut, and so you can get good price. But medium or long term, I think it's not really good for the organization. But anyway, we are living a very hard moment at the moment. We have 2 wars are running. So we have one war in Ukraine, second one in the Middle East. So OPEC Plus has to take a decision anyway, because you have to keep a good stabilize the prices. And we have seen how they are ranging from $75 to $83 in the last 4 months. I think the question we can ask is, how could be the prices if the OPEC is not really cutting the supplies at the moment?
Well, certainly there'd be a lot lower. Brent crude oil trading this morning at $83 and some change. Geopolitical risk premium, the oil price remains in low single digits. Seems to be overwhelming agreement on that point. We'll post that survey question on social media. But Brent crude oil stuck at ends the week at the Goldilocks spot of $83 a barrel. Producers and consumers seemingly relatively content. Nobody's barking on that at this time. So we will wait to see the OPEC Plus decision for the second quarter. Will they roll over a whole quarter, or as Jamie indicates, maybe just a month? We should get some soundings in London next week, big gathering of IE week. So a good time to sort of get, although last year the whole of IE week was completely wrong, the year of 2 halves that never came, but nonetheless made for good conversations for 5 days in London. We'll wrap it up there. Thank everybody for joining us today. Jamie Ingram in London, and we look forward to seeing Jamie next week. Dr. Rad Al-Qadiri in Washington. Dr. Rad, I don't think will be in London, but if you are, we'd love to see you. Shuaib Boutamin in Algeria. Great to have you on the table. Look forward to future opportunities together. Have a great weekend, everybody. All the best.
Bye-bye. Thank you very much.
Bye, guys.
Cheers.
Bye.